How about 10xing your monthly income with just 5 smart investments? Sounds too good to be true, right? Well, stick around, because in this video, we're diving into the world of dividend stocks currently at their 52-week low and can dramatically boost your monthly income and turn your portfolio into a cash flow machine. We're talking about companies with rock-solid fundamentals, strong dividend histories, and immense growth potential. And guess what? They're all trading at their lowest prices in a year, making now the perfect time to buy in. So why wait? Let's get right in. Number 5. Johnson & Johnson. If you're searching for a reliable source of income, J&J is a stock to consider. Despite recent fluctuations in its stock price, which hit a low of $143.13 over the past 52 weeks, marking a decline of 16.65% from its peak, savvy investors view this dip as a prime buying opportunity. Johnson & Johnson has increased its dividend every year for over 6 decades. That kind of consistency is incredibly rare and puts the company in a prestigious group called Dividend Kings. But what makes J&J stand out in terms of dividends? Let's dig in. In mid-April, J&J announced its latest dividend payment. They raised the quarterly payout to $1.24 per share, totaling $4.96 annually. It represents a 4.2% increase from their previous payout. If you owned the stock by May 21, 2024, you'll receive the next dividend on June 4, 2024. At its current price of around $145.45, J&J's dividend yield is an impressive 3.31%. To put this in perspective, the average dividend yield of the S&P 500 is just 1.4%. If you invested $1,000 in Johnson & Johnson, you'd earn about $33 in annual dividend income, compared to just $14 from a similar investment in an S&P 500 index fund. One of the reasons people love investing in Johnson & Johnson is its long history of dividend growth. For 62 consecutive years, the company has increased its dividend. Over the past decade, they've typically boosted their payouts by a mid-single-digit percentage each year. This consistent growth is a big draw for income-focused investors. Johnson & Johnson isn't just about dividends, though. The company has a robust market cap of $350 billion and a gross margin of 68.49%, reflecting its strong financial health and stability. These numbers are part of why J&J can keep rewarding its shareholders year after year. One of the biggest reasons is that investors can rest easy knowing J&J can comfortably afford its dividend. In 2023, the company generated about $18 billion in free cash flow, which more than covered the $11.8 billion it paid out in dividends. On top of that, J&J has a rock-solid balance sheet with $26 billion in cash at the end of the first quarter and only $7 billion in net debt. This financial strength makes Johnson & Johnson a really solid dividend stock. The company has an amazing track record of increasing its dividend yearly for over 60 years. It offers a higher yield than the average S&P 500 stock and supports its payouts with a healthy financial profile. All these factors make J&J a great stock to buy and hold in the long term. Number 4. Intel Corporation stock INTC. Let's dive into Intel Corporation and unpack what's been happening with their stock lately. Currently, INTC is trading at $33.97 per share. Over the past year, the stock has seen a modest uptick of about 0.65%. However, looking at the shorter term, over the past 6 months, it's down by 18%, and in the last month alone, it's dropped nearly 20%. So what's behind this significant decline? The sharp downturn followed Intel's latest earnings report. In Q1, they reported non-GAAP earnings per share of 18 cents, which beat expectations by 4 cents. Revenue increased by 8.5% year over year, but fell short of expectations by around $80 million. Despite these numbers, investors have serious concerns about Intel. Some of the key issues include execution risks, extended losses in their foundry segment, challenges in gaining market share in data center AI processors, and heightened exposure to the Chinese market. Recently, Intel outlined its strategy to expand margins, which has become a critical focus for the company. When we look at their profitability metrics, it's evident that Intel has faced challenges. Over the past decade, their gross profit ratio averaged around 56.65%. However, this ratio has declined significantly in recent years, dropping to 39.72% in 2023 from 55.45% in 2021. Another concerning trend is Intel's soaring capital expenditures. From below $12 billion in 2017, they spiked to over $25 billion in recent years. This increase in spending has coincided with declining revenue per share, painting a troubling picture of their financial health. Although high capital expenditures are common in the semiconductor industry, Intel's levels far exceed those of its peers, except for Micron. From a dividend perspective, Intel has historically been a dividend-paying company. However, their dividend yield is currently low at 1.61%. Moreover, Intel had to cut its dividend significantly in 2023, reducing it from $1.46 to 74 cents per share. This move came as the company struggled with negative free cash flow and could not cover dividend payments from its earnings. Looking forward, Intel faces considerable challenges in restoring investor confidence. The upcoming quarters will be crucial as the market awaits updates on their strategic initiatives and financial performance. Analysts have shown caution, with downward revisions outnumbering upward ones in recent earnings expectations. So buying Intel at a low price means acquiring shares when they're undervalued compared to historical norms or market expectations. If Intel can successfully address its current challenges and execute its strategic initiatives, the stock price has the potential to rebound. Number 3. The Hershey Company. The Hershey Company, known by its ticker symbol HSY, is all about chocolates and sweets people love. Its stock is currently trading at around $196 per share, close to its lowest point in the past year. This could be a sweet opportunity for investors looking for a good deal. What makes Hershey attractive, especially for those who like dividends, is its solid history of paying them out. Currently, it offers a starting dividend yield of about 2.83%. Even better, Hershey has been increasing its dividend payouts by an average of 9.83% yearly for the past decade. That kind of growth shows they're serious about rewarding their shareholders. Despite the recent dip in its stock price, Hershey has been pretty steady over the years. On average, its stock has increased by around 6.64% annually. That might not sound huge, but it adds up nicely over time, especially when reinvesting those dividends. Let's break down what this could mean for someone like Jim. Say Jim puts $10,000 into Hershey stock today. He could see that grow to about $10,995 in just 1 year. Keep it there for 10 years, it could balloon to $27,322. Stick with it for 20 years, and we're talking about potentially hitting $73,500. And if Jim holds on for 30 years, his investment could reach a tasty $245,600. He could be pocketing about $1,267 in dividends each year, which adds up to around $18,750 over the 3 decades. What's more, Hershey's finances are in order. They've been generating good cash flow, which means they can reliably pay those dividends. For investors who like steady income, that's a big plus. With its track record of increasing dividends, solid financial health, and current lower stock prices, Hershey looks like a great pick for anyone who wants both income and a shot at growing their investment over time. As a trusted and loved brand, Hershey stands out as a smart choice among stocks that are trading at their lowest in a year. Number 2. Pfizer. Let's take a close look at Pfizer, known by the ticker symbol PFE. For several compelling reasons, it stands out as a potential gem among 52-week low dividend stocks. Firstly, let's talk about Pfizer's dividends. Over the past decade, Pfizer has steadily increased its dividend payouts, climbing from about $1 per share to $1.68. This positive trajectory indicates that investors in Pfizer can expect a growing stream of dividend income over time. While Pfizer's stock has faced some challenges recently, dropping approximately 3.42% over the past year, it's not all negative news. Given Pfizer's history of increasing dividends, investors might view this low point as an opportunity to buy in at a discount. Currently, Pfizer offers an attractive dividend yield of 6.09%, which is quite appealing relative to its stock price. Moreover, Pfizer has maintained a dividend growth rate of 5.92%. Now, what about Pfizer's ability to sustain these dividends? Historically, Pfizer has had a decent track record of covering dividend payments with free cash flow. Admittedly, there was a blip in 2023 where they didn't quite cover it, but this was largely due to exceptional circumstances related to the vaccine boom. Another factor to consider is Pfizer's low beta of 0.56, which indicates that the stock price is less volatile than many others. This lower volatility could reassure investors who prefer a smoother investment journey. Number 1. CVS Health Corporation. CVS Health Corporation, ticker symbol CVS. This company, known for its pharmacies and healthcare services, has been facing a bit of a rough patch lately in the stock market. Currently, CVS is trading at around $55.97 per share, which is quite a drop from its highs over the past year. So we can say that CVS's stock price has declined by about 19.7% year to date and a staggering 29% over the past year. Just in the last month, the stock plummeted by 24.44%. CVS's recent quarterly earnings report largely triggered this sharp decline, which disappointed investors. Let's break down their latest earnings. CVS reported non-GAAP earnings per share of $1.31, missing analyst expectations by a significant margin of 39 cents. On the revenue side, they brought in $88.4 billion, a 3.7% increase year over year, but still missed estimates by a hefty $800 million. This disappointing performance led to CVS witnessing its largest one-day stock drop over a decade. One of the major factors contributing to this decline was CVS's revised guidance for the year ahead. Back in February, they projected earnings per share of at least $7.60. Fast forward to their recent report, which shows that figure has been slashed to $5.64 per share. That's a massive downgrade. Naturally, investors were not thrilled about it. Looking at some financial metrics, CVS has seen its revenue per share grow impressively over the past decade, climbing from around $104 to about $278 per share. However, the picture isn't as rosy regarding earnings per share, which has been more volatile and less consistent in growth. For instance, earnings per share fluctuated from $3.77 in 2013 to $6.49 in 2023, showing less stability than revenue. One critical measure of a company's efficiency is its return on invested capital, ROIC. For CVS, this figure stands at a concerning 6.6% in 2023. Typically, companies aim to have an ROIC higher than their weighted average cost of capital to create value. With an ROIC below the WACC, CVS might be destroying shareholder value rather than creating it. Switching gears to dividends, CVS has a mixed bag. While they've shown commitment to returning cash to shareholders through dividends, with a current dividend yield of around 4.75%, they did go through a period of stagnant dividend growth a few years back. They've been hiking dividends recently, boasting a 5-year dividend compound annual growth rate of about 5.87% and a 10-year CAGR of 9.23%. Conversely, CVS's free cash flow has generally been healthy, covering its dividend payments since 2019. In 2023, for instance, they generated approximately $10.4 billion in free cash flow while paying out $3.1 billion in dividends, resulting in a reasonable free cash flow payout ratio of around 30%. Despite these challenges, some analysts believe CVS could be slightly undervalued based on dividend discount models, projecting a potential price per share of $614 above its current trading price. Now, which company would you prefer investing in? Let us know in the comments section below. Stay tuned and subscribe for more amazing videos.